Short selling adds a little layer of complexity at first, but it's a relatively straightforward concept. When stock prices fall, for example by $15, there is potential to profit from that drop. At first, shares are borrowed and then sold at a high price, in this case $70. Then, when the price plummets, in this case by $15, there is potential to realize $15 of profit once the stock is bought back at the price of $55. Basically, it's the reverse of traditional stock market investing. Sell high, then buy back low. And in this example, there is potential to make 100% return if the stock theoretically drops to $0. Not bad at all, but there is a downside to this, and we'll discuss the risk. The stock can only plummet to 0 and no more. However, a stock can theoretically rise infinitely, but that of course doesn't happen. Though even if we take a realistic scenario such as going from $70 to $100, there's still the potential for a 30-point loss here. Then, not unrealistically, as seen with many stocks in the past, the price could continue rising, for example to $250, and that would increase the losses to $180 potentially. And even though it's less common, stocks can continue rising even much higher, perhaps to $1,500 for example, and that would increase the losses even more. Then when leverage is in the picture, essentially when additional borrowing and selling is allowed for 2, 3, or even more times the original amount of the stock, losses can be inflated infinitely more. So short selling is definitely more of a short-term strategy to protect or profit from natural downturns in the market that happen from time to time. Though it's definitely not a buy and hold for the long-term type investment, or even a medium-term strategy in most cases. Inverse exchange traded funds, or ETFs, replicate the inverse movement of certain assets, stock indices, or stock market sectors through the use of derivatives, shorting, and other methods. So for example, when the S&P 500 index takes a downturn, such as in early 2020, there's the potential to make a profit from that down move. The S&P 500 is quite accurately tracked through the S&P 500 ETF, ticker symbol SPY, which has its counterpart in the inverse S&P 500 ETF here, which would allow for profiting from that downside move seen in early 2020. However, when the market turned around to reach even newer record highs, that would of course present the same risk as shorting. Not to mention, of course, there are 2 times ETFs with double the leverage, and that would naturally present double the profit potential but double the risk as well. Even more profit potential but equally greater risk with the 3 times S&P 500 short ETF. Certainly, like shorting, this will be a very short-term strategy as the market historically continues higher in the long term. And in case you are wondering or forgot about percentages and proportions, these inverse ETFs seem to be rising more than they are dropping. However, that's just because their percentages, not the absolute price in terms of dollar amount, which is dropping much more than it is rising. Next is a very simple strategy, but one that many don't follow. Basically, avoid margin. Don't buy on margin. As seen with the last 2 examples with short selling and inverse ETFs, there's a real heightened risk when using leverage and buying on margin. This doesn't only have to apply to the infinite potential for loss with short selling or the double or triple losses that can occur with leveraging on margin. It can also apply to financing real estate with mortgages, either for personal property or investment property. Once again, just think back to the famous 2008 recession as a good example. There is no one single safe asset, and real estate is no exception. Basically, don't spend more than you can afford to lose. This doesn't only have to apply to trading and investing in the financial markets, it also applies to purchasing everything with credit cards, consumer goods, and so on. If risk is avoided, and there is enough cash on hand for opportunities, it's still important to maximize value buying and avoiding buying traps in the stock market when opportunities arise. Obviously, it's not always possible to predict the exact bottom or top of a market, though it is still sensible to be looking for opportunities to enter the market and exit the market at more favorable price ranges and time ranges. As we saw earlier with those many chart case studies, there are specific phases in terms of technical features that happen when stock markets decline. During the first approximate phase of an SMC, when an uptrend ends with a decisive downswing, approximately 10%, that is approximately 1/3 of the SMC's price drop and the duration. This is more common for SMCs that drop in the 20 to 30% range. However, it's still somewhat applicable to larger scale SMCs. More drastic variation emerges when an SMC grows beyond 30%, where the market can drop upwards of 66%, so approximately 2/3 of the SMC's price drop can occur halfway through its duration if it's a very large SMC. This was demonstrated quite well with the Shanghai Composite Index chart we saw earlier, where the market began a very rapid drop after breaking quickly through the temporary support. Of course, during the development of a real live SMC, it will be difficult to tell if it is halfway through its price drop and time duration. However, we can look for a few clues, as after the second phase of the major rapid drop, the market tends to continue dropping, but at a slightly slower rate, as we saw in many of those chart examples. There can still be rapid surges down, but after an SMC has passed the halfway to 2/3 point in its price drop and time duration, it normally begins to settle down and slowly decline. And that is when it would be more reasonable to begin considering value buying opportunities, as the market has presented a big discount with many of the most volatile dropping phases over. Then when there's a first decisive upswing, it is quite useful to use tools such as the Fibonacci retracement to determine whether the market has recovered at least 20% of the lost value from the present drop. A major upward reversal and possible recovery is more likely if the market, like any uptrend, begins making higher highs and higher lows. There is still risk, of course, with entering the market during the development of an early uptrend. However, that is when opportunity is presented to enter the market at very discounted prices. After understanding the phases of an SMC and the approximate metrics, it is more favorable to enter the market when it has presented these characteristics, and it will be helpful to not enter the market all at once. Instead, it's better to space out the entries into various points so that minor drops won't be as big of a danger. And once the market continues the uptrend and regains at least 50% of the lost value from the SMC drop, it is much more likely it is on the way to a full recovery and possibly to eventually break out to newer highs past the point where the market peaked at the beginning of the SMC. In order for all of the previous strategies to be more effective, it is helpful to stay disciplined with a long-term perspective. Since an SMC is largely out of an individual's control, it's counterproductive to focus on the small details and get caught up in the fear and panic. Accept the conditions and take appropriate measures to safeguard capital, but don't go down the unhealthy road of constantly checking the news and performance of portfolios, because even the smallest drops take time to develop and recover. Next, the world of stock options provides one of the most complex and flexible strategies. This is definitely one of the topics in this strategy discussion that requires much more practice and learning in order to apply successfully in the market. This isn't appropriate for everybody, but if it is of interest, it is very useful to at least begin understanding the basics. They certainly present a very steep learning curve for beginners, and they still offer a challenge for more experienced traders and investors from time to time, because if stock options aren't utilized appropriately, they can present many of the same high-risk factors as short selling and leverage discussed earlier. To outline some options strategies, we can begin with the protective put, because buying a put is relatively straightforward and there's defined risk. Covered calls are naturally on the lower end of the risk spectrum for options strategies, and if they're used during the entire duration of an SMC, it's best that they be used with stocks that will be held for the long term. Next, a caller provides a good first multi-leg strategy that provides lots of protection against downside moves during an SMC. But at first, it will take some practice to select the right strike prices, and there is low to no profit potential, as it is more of a preservation rather than profiting strategy. Normally, iron condors and butterfly spreads provide opportunity to profit from relatively flat and neutral price movement in the stock market. But when they are skewed, they provide opportunity to profit from more directional movement, and this can be helpful during the rapid downward phases of an SMC. And a broken wing butterfly spread provides similar benefits, though it is quite useful to also use it when the market continues making newer highs and there is hesitation in the market. Depending on which strike prices are selected and how the broken wing butterfly is skewed, it can help in reducing losses and even profiting when the market makes a sudden downturn. Then another reminder, because even large institutions, not to mention individual investors, still find trouble in controlling spending, regardless of whether the market is in a downturn or not. Another reminder to not buy consumer goods just for show, frivolous expenditures that have depreciating value. Making and sticking to a budget never hurt anyone, as long as they don't take the budget too far and regiment an entire life around it. There is certainly more to life than money, but it is important to use it wisely, no matter how much profit is made. Fear of judgment for being cheap and frugal is not very sensible during an SMC and economic downturn, when financial strain will be more commonplace.